All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. I have a chart of Caterpillar up here. In Caterpillar this morning, we had analysts come out and lower their earnings expectations on Caterpillar. And while not terribly uncommon, it is something that we're going to continue to see, and it is something that I think the market is not as prepared for as what it probably should be. But as we go into this earnings season, just looking at kind of how things have transpired and what's going on, and more importantly, what's not going on. Right? Some things could change between the U.S. and China, but let's face it, we're not seeing improvement. Right? We're absolutely not seeing improvement. We're seeing erosion of the economic data, and that is going to lead to analysts having to lower a lot of their earnings expectations. And we've seen analysts be slow on that because they don't want to go lower the earnings expectations, then have something transpire where there's a deal with China, and then go, oh, well, now we have to ramp them back up. And so we've seen analysts be very slow on this earnings expectation downgrade, but we're starting to see them come out, over the last week, and Caterpillar hit here this morning with that. And they're not pretty numbers. We're talking about going into a period where the numbers they are. Right. When it comes to numbers in the market, let me backtrack just a little bit. When it comes to the numbers in the market, we're talking about second derivatives. And what do I mean? Well, you have this thing called the first derivative, right? Is something going up or down, right? That's all it is, up or down. Easy to see, up or down. That's the first derivative, right? You can look on your speedometer on your car, and you can see how fast you're going, right? That's the first derivative. Are you going 40 miles an hour? Are you going 60? Are you going 20? Right? This is the first derivative world, up and down. And it's where a lot of people kind of, their minds are when it comes to the market, are things going up and down. But when it really comes down to analysis of the market and understanding the market's a second derivative world. What does that mean? Well, second derivative is a rate of change, right? It's a rate of change. So it's not whether or not the economic data is improving or getting worse, right? What's the rate of change? Are we seeing the numbers improve but at a slower pace? Are we seeing the numbers get worse but at a faster pace? We tend to see that when the numbers get worse but at a slower rate, we tend to see stocks go up. And it baffles a lot of people because then, well, the numbers are bad. They're ugly. They're not doing anything. Well, when they get worse at an accelerated rate, that's when we see stocks really sell off. We see the big rallies happen when data gets better at an accelerated rate, right? Press on the gas. But we have been in a market now for quite some time where we are seeing the data, the improvements have been slowing, right? The rate of change is almost, or the up and down factor is almost shifting from, going up at a slow pace to going down. And we're starting to see this rate of change, to the downside accelerate. Right, so the rate of change ultimately increasing, and we're seeing that out of the data. Now, how long does that last? How does that all play out? Obviously there's many things to come, but it's it is a fairly ugly situation that the market has itself into right here and right now, and we're the big elephant in the room in terms of U.S.-China trade relations. And let's face it, U.S. made a move here this morning that is sending stocks down. Right, we have the S&P near its lows of the day. Let me pull it on up. But you can see overnight S&P futures were trading up here, 28.50. I mean, market was set for a 15-point gap up, right? And that was while the Asian session was going on, and then Europe opened up. down. And then the U.S. announces that they're adding some Chinese firms to the blacklist. And they're doing it just ahead of the trade negotiations, right? And so it spooks the markets, and that's what we are seeing, here today, is seeing that come in, and it's ugly, when it comes down to it. Now we are seeing the banks lag. The banks lag pretty good here this morning. In fact, they're one of the big reasons that we're seeing the market drop. And you can see, like Bank of America, we talked about this reversal last week, and okay, we have the reversal. We talked about how many times these types of reversals get erased. We're seeing it get erased, and a lot of times when these reversals get erased, what do we see? We see new lows come in, and I would be very surprised if we don't see that with a lot of these names. Now, for the challenge, I decided yesterday I was going to hold off on Visa. Wasn't going to make the trade. Oracle wasn't going to make the trade, just with the risk factors. I was able to hold off because the options just didn't make sense, and we talked about why I'm not getting into those, with the risk factors that are out there. We have a bearish market vibe, bullish signals, I decided to hold on off there. Now we are in a position now where we can see a lot of these, turn bearish with some downside 3-7 action here on it. If we pull up the scans, we don't have any new signals here this morning, but we have some potentials here for this afternoon, and I suspect we'll have a few more on this list. But the downside crossovers on the watch list here today: Facebook, Visa, Verizon, all with downside crossovers. Now these are all stocks that had upside crossovers last week, so they've been in some consolidations. Are they ready to break on down? They could, but so far this morning they are not. They're not signaling. We have two upside crossovers here, gold and GLD. So yesterday we had gold, Barrett Gold, with an upside crossover, but that faded into the close. We're getting that today. GLD had a downside crossover yesterday, getting the upside version today. They're not enough to signal. We're not seeing trend signal come in here just yet with them. We could on GLD by the end of the day. I would not be surprised to see a bullish signal on GLD. GLD looks a little too far away, but we'll see how that plays on out here. Okay, you'll notice that we don't have downside crossovers on things like Bank of America, and that's because it didn't have an upside crossover. We talked about on Friday how if the market rally is going to continue, we will start to see a lot of stocks with upside crossovers. Well, we only had a handful, and now we're starting to see these stocks fade without these fresh new downside crossovers, across the board. So we'll only get a handful of downside crossovers, and the ones that signal will go out and play. But is this a bearish shift in the market or normal market chop? Well, I continue to show the bullish percent index, and I'll continue to show it. Because when we have rally days and the bullish percent index does not go up, that doesn't bode well for the markets, right? It's one of those just simply where we have seen the bullish percent index go down on the down days. It's gone down on the up days. And until that shifts, until that changes, market path of least resistance tends to be lower. And we see this a lot. This isn't unusual. This isn't something strange. This isn't something that's just because of, what's happening right now. This is a very normal type of thing here in the market. And we saw back here in August, we saw a shift, right? The bullish percent index was going down even on some of the up days. But then we started to see some down days, and the bullish percent index wasn't going down. And what happened? We saw the market rally, right? And so if you're looking for a big market rally, you want to see what? You want to see the bullish percent index stop going down on down days, and you need to at least see it go up on some of the up days. And so far we don't have that. So far that is not taking place, and so leaves things in a more bullish type of position. We are in a period right now where we have more new lows being set on the market than new highs. The strength of the June-July rally in the market was significantly greater than the strength of the September rally that we had. The September rally, stocks didn't set new highs. We didn't see a lot of stocks setting new highs the way we did in June and July. We've seen some serious erosion here. I would be very surprised if we don't see some continued erosion here with some new lows, being set as we go forward. But the metrics are squarely in the bears' favor right here, and it is one where what's the path of least resistance? Well, we're going to have some chop, but path of least resistance, is going to continue to be lower as long as this IWM remains below its 7-day moving average here. Okay, so normal chop, bearish shifts. To me, this looks much more bearish than some of the normal chop. But again, it's only going to take a news element to drive it the other way, and obviously, it can take some news elements to continue to push things, push things down. Be a little bit more bearish, had we seen a little bit of a new high here in September and seen that we raced, but I think you do have to be a little bit cautious that a new high can still come in. And that's just the mechanics that we are in right now. I'm going to go back here to a chart because I want to discuss a mentality here, and we're going to go back to 2007 to January of 2007 and go to January of 2009. So we're going to talk about 2 years, right? If you traded the market during this time, it was a tumultuous time. A lot went on. Everyone remembers Lehman Brothers. And the Lehman crash here in the market, Lehman went under, and the market gapped on down right here, where I'm putting my blue circle. That was the Lehman gap, and, then the market was, dead and buried. But one of the things that is lost is how this whole process played out. Because it wasn't, all of a sudden the markets woke up one day and Lehman Brothers went under and, okay, now the market's just sold. That wasn't the case. That wasn't what happened. We saw the first warning sign back here in February of 2007, and this was China. And some growth numbers out of China. A little bit of worry from the economic data. Is it enough to send the market down? Yes. Is it enough to send it down permanently? No, right? But then we get into this summer, May, June, July of chop, and it was crazy chop. And I remember it vividly because I got my butt handed to me a little bit there during that time because we hadn't seen that very much. And so we had this chop element come into play. And then we saw the market correct. We saw the market sell off. The market sold off on what? Sold off on the bank issues, subprime, right? The Fed isn't reacting fast enough. It's the bond rates that, we're seeing an inversion in the yield curve. Sound familiar, right? All those issues start to come to the forefront. Need to pay attention. Okay, authorities start to pay attention. Fed cuts rates. Okay, market pushes up to a new high. But you know what's happening? The economic data is eroding. The economic data, we see some mixes. Some is good, some is bad, but overall, starting to erode. We're in a period where valuations are pretty stretched for a lot of companies, but, where else are you going to go? You still got to own stocks because of the recent performances. And then we get this December sell-off and this January Bear Stearns bankruptcy. Bear Stearns goes to zero. In February, and we get all this banking issue in January, February, really starting the year off to a sluggish start. And if you remember that time period, it was all over the place. Bad January, bad February, market's going down this year. And then all the market proceeded to do, March, April, May is go higher. And, we started to hear what? We start, the issues are done. It's over. They've been priced in. It's over. But what we didn't see is we didn't see corporate earnings really rise to a really significant degree. What we saw is this kind of bubble form within the material sector, the shippers, right? Dry ships, U.S. Steel, those types of stocks. We saw bubbles, being formed, but your banks, your regular kind of stocks, we didn't see them going and setting new highs. And then we got the kind of normal summer correction. It's just kind of put off as, it's summertime. This happens in the summertime. And, we get a little bounce from it. And then Lehman goes under. 3 days later, the market set a new short-term high, right? There was this idea that Lehman went under. Okay, you know what? That was the worst of it. It's solved now. We got that out of the way, and the market popped. This wasn't Lehman happened, so everybody knows to sell, and everybody goes out and sells. That wasn't what happened. We got this big gap down, and we got this 2 days of sell pressure, and then we got this monster reversal where the SPY went from 89 up to 102. 89 to 102, that's 13 points on an 89. That's, 15%? 16% there in a matter of 2 days? You can imagine the headlines. Market pops, blah, 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 bears get splattered, bulls are running. It was one of those where you saw the analyst on TV and all of the personalities coming out and talking, hey, this is great, grand, wonderful. We finally have this out of the way. The markets can finally get out of this drudgery that they have been in now for 2 years, and they can get going again. That was the talk. And then what did we see? Right? We saw absolute, implosion here, take place in the market. And you'll see what the rallies look like back here. They were phenomenal rallies, phenomenal sell-offs. Was the news different right here than what it was right here? Not really. But you finally had market participants do what? Market participants stopped butting all of the bad news. They couldn't but it anymore. And right now we continue to be in a market that's a but. But there's no other alternatives other than stocks. But, a deal's going to happen between the U.S. and China. But, okay, we're seeing the erosion in economic data, but it's going to turn around. We're seeing earnings start to fall, but they're going to turn around, right? Because in 2016, we saw that, right? We saw, the earnings turn around after going into a little bit of a revenue recession, right? There's a lot of things that are being but in this market. And we could continue to see this but, mentality and have things drive higher. But the thing you have to really kind of watch for and be cautious of is that but mentality turning into an oh no mentality. And that's what happened back here. It just turned into an oh no. The buts went out the window. And it turned into an oh no, and it led to some very heavy, very severe selling. And was it fundamental based? Was it because, this company is overvalued and their earnings are blah, blah? No, it wasn't. It was, I can't own things right now because of the environment. I have to save cash and live to fight another day. That was the mentality. And now you start to see what happened. You see the market breaking down. What do the headlines start to look like? They look terrible. So what do normal, average IRA investors, 401k investors do? Well, they say, hey, you know what? I can't take this anymore. I got to get out. I got to, live to fight another day. They call their broker. Their broker says, hey, you know what? You got to be conservative. You got to live to fight another day. So they sell. And it cascades. Can we avoid this cascade effect with everything that's going on out there? We can. The market can avoid it. The market is very good at avoiding, these types of situations. These types of situations only happen once every 10, 20, 30 years. They're not super common, right? But it is one of those where, the market's in that type of position where it could go through it. But a lot of the buts need to get erased. And right now, we still have a lot of the yeah buts. And where do you see them erased? How do you see them erased? You see them erased as price action erodes, as price action gets worse. We talked about, last week how fund managers, it was very evident that fund managers were leaving the market. Right, and again, it's not all fund managers. It's not 50%. We're talking just about a small portion leaving the market. And so, what does that do? The more participants that leave the market, the more volatility that there is. Take a look at the volatility that we saw down here. It's easy to look and go, whoa, the market went down, but look at the volatility. I mean, the market went from 66 on the SPY to 84. I mean, that's an 18-point rally. That's almost 30% rally in 3 days. That doesn't happen unless you have a lack of participation, a lack of price stability. And as we go into the rest of this year, right, we are seeing that participation factor start to wane. We're going to start to see that volatility factor increase, and I suspect we're going to see bigger rallies, bigger sell-offs, throughout the rest of the year. And I know, maybe tired of the chop and things like that, and I'm right there with you. I don't want to see any more chop. Let's go. Let's see some trend, emerge and form. But, the market is what it is, not what we want it to be. And, it is one where right now, are we looking at the normal chop? Are we seeing bearish shifts? Well, right now we're seeing some bearish shifts, but not enough to kind of be in this, monster, sell-off, monster pullback range here just yet. All right. Thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you this afternoon. Take care.